You're listening to financialradio.co.uk. My name's Giles McMullen, chatting to Bill Rook from Redmayne Bentley. Hi, Bill.
Hi, Giles.
Now, let's start with your first chart, Bill. And, well, you tell me, what would you like to start with?
Well, I've got the S&P to start with, the S&P 500. We're looking at that one, and we're close to getting a golden cross, but using an exponential moving average, which I've highlighted with the red line, the 200-day moving average, effectively, we could see that the S&P failed where the box is on the right and on the left to get through, and this is a mirror of what we had basically in June of last year. We've sort of tickled with the tops of it, or trying to hold on to it, and it's failed, and it's moved back down through the 50-day, which is the green line on the chart.
So what does that mean? You said golden cross. What is a golden cross?
Is 50 across the 200, and that is the key to a bull trend in my way of looking at this chart. So on the index, so it's not happening at the moment. So we need the green to cross the red from below.
Right.
And it's not happening, and it hasn't happened for a year. But short term, and I say short term, we have an oversold situation. What I've done here is use the breadth indicator, looking at the number of shares percentage-wise above their 10-day moving average on the S&P. So when it gets to the top end, it gets a bit pricey, and when it gets to the bottom end, it gets cheap, and we're at the cheap end now. So
if your trading horizon is what, a month or less, you'd be buying.
We're looking for a rally here now. Where this works quite well is when things are above the moving averages. When you don't, this is the problem. When you don't have that, this is the problem, and it's highlighted by these hoops where we've been oversold on the chart before. And you can see that yes, at some point there was a rally, and at the extreme point there was a rally in March. We were oversold then, using this sort of simple breadth indicator.
Now, a quick, simple question, Bill. I mean, if you look at the market from March, I suppose you'd say we're in a bull market. If you look at it from last June, you'd say we're in a bear market. Where are we?
No, we're not in a bull market because the green has to cross the red. All we're doing is having a rally upwards towards the moving averages. And if we get what would actually constitute a bull here would be a 50, the green crossing the red, which would say the golden cross. And when we get the movement above that, we're going to look at a chart like that today, a bit later on, to show you what a bullish chart looks like.
Right.
So this is just a recovery chart.
This is a bear market rally at the moment.
A bear market rally, yeah, it is. And what we have at the moment is other indicators supporting that. The yellow indicator at the top, the yellow backed indicator, is one of my favourite ones, is a longer term trend. It does suggest that we are in a more bullish phase. Now, when it's below 0.5, this suggests that we're in a bearish phase. We shouldn't be in the market. When it starts climbing above minus 0.5 and beyond, then it looks more bullish, and we are. That would actually say we're in a reasonably strong position. That's a weekly version of the indicator above, which is the daily version, which suggests we're oversold and possibly negative situation. So oversold, possibly negative trend, but we are. But the backdrop of a medium term upswing. So. We can have it whichever way you want really at the moment. The market's a bit lower than it started at the start of the year, but I think at the moment we're in an oversold situation on the cusp of being bullish. Will be the easiest way of looking at this market.
Okay, Bill.
Right.
Now, you were talking about a golden cross that we're going to have a look at next. I'm guessing this is fresnillo, is it?
Yes, fresnillo. Now, that's exactly, Now the red one here is the 200-day. The green one is the 50, and you can see the cross coming in. Now, when you've got that, you've got behaviour. Now, then you start looking at the top of the chart there, and you can start saying, then you have rationale, everything applying well. You have an oversold situation where the hoops are, and you expect bounces to come in because it's actually in trend mode. The problem at the moment is that it's testing the 50-day, and is it going any lower or not? Now, this has been driven up by, or because the price of silver has rocketed. Now, the silver had its best month in 22 years in May, and now it's cooled off a bit. This share went 20% above, as the indicator, second window above the bottom chart there suggests, 20% flat above the silver price. So it's well outperforming. So for that to continue, it's improbable for that to continue. It's got to come back. It's overbought in that zone there. So you'd expect it to come back. Longer term, of course, you might be happy to hold on in there. Shorter term, I expect this to bounce. I expect the price of silver to probably pick up as well. Shorter term, this is going to be oversold. Longer term, on the upswing, as long as we don't go through the 200-day moving average. If we go through the 200-day moving average, then I think all bets are off, and that's just stop.
Okay, Bill, right, let's have a look at the next one, which is the Philadelphia housing.
This is American. This is the interesting one. I thought it was interesting in as much that we're looking at this index of construction jobs, as you know, in America. So it measures what's going on in the construction front. Now, what I wanted to introduce here is a very, very simple method of saying overbought, oversold. How do we know it's going to be a bottom? Well, what I've introduced here is an MACD, which is a moving average divergence indicator, which is a difference between two moving averages. And when you get to a low point where you have the box and the circle, you look at the MACD to see if that's supporting or not. And if the MACD is at a low point, then it suggests the trend is going to continue. If it isn't, then it's probably going to be a bounce. So there's a yellow line on the indicator above that showing the MACD is actually higher than it was previously, and there's a low point where the box is, you expect a rally. And where there's a hoop at the bottom there, the new low, and there's an MACD going higher than the previous low, then it's going to rally. So this is what we're doing, of rallying from the lows points here, and that indicator will help you in at the bottom of the market, assuming that it rallies. So that's how that works. And the problem is here is that obviously it's not going to work all the time. We did have a low point between the circle and the box, but it wasn't supported necessarily by the MACD unless you take it from the real lows that it's going to bounce. But that one wasn't as clear cut to go in as say the other two were. As it stands at the moment, this has failed. This is the green and the red. The green hasn't crossed the red, so it's bearish. And it crossed back June 2007, as you can see on the
and it hasn't crossed back up since.
And never has crossed it. So housing construction is a no-no. It's recovered a bit, but it's still in the doldrums to me. And until those lines cross over, we haven't got anywhere near a recovery yet. We just have inertia, and we wait and see what happens.
Okay, Bill, thank you very much for that. We will chat again next week. Bill Rook from Redmayne Bentley. Thank you very much.
Pleasure.
Bill, that's